The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome to the Fed15 podcast presented by Serving Those Who Serve. Each week, we discuss the latest news and info that Feds need to know in 15 minutes-ish or less. So whether you are a seasoned federal employee or just starting out in your career, we've got you covered. So grab your coffee, your energy drink, your green juice, whatever you need. Kick back and we'll let you know what you need to know but might have missed. We are your host. I'm Dan Sipe, and I am joined by the dazzling and inimitable Katelyn Murray.
Hello. Another week. Well,
yeah, another week sometimes where I feel like we're through the looking glass a little bit.
Another week that's felt like a year, right?
But Feds, we are seeing you and talking to you in record numbers. Katelyn, interestingly enough, we crossed the 1 million visitor milestone in the last 12 months. There are sites out there, touting that they've had 250,000 in their history. We had 1 million in 12 months, and that means the world to us, folks. We have worked really, really hard to create a place where you can get the information you need, and this is certainly part of that. So,
absolutely. Yeah, absolutely. Well, this week's episode is going to be, I feel like this is a little bit of like a return to form. I feel like a lot of what we've been covering has been very much, trying to get the information out as we're getting it, trying to, keep up with this crazy 24-hour news cycle and
I concur.
And cover what needs to be covered, obviously. This week, we're getting back a little bit to basics. We're covering two kind of non-time sensitive, for a large part, non-stressful topics, which is great. Dan's going to talk with us a bit about RMDs and federal pensions and how you need to coordinate your withdrawal strategy there. And then I'm going to talk a bit about ESG investing. So ESG investing is a really interesting kind of topic. It can be a minefield, right? Because we're kind of crossing into the area of values, and those are not necessarily homogenous across the population. But for those who are interested in ESG investing, there has been an increase in the concept of sustainable investing. And we know that there may well be Feds out there that are looking to align their retirement savings and their investment portfolio with personal values. And a lot of, ESG investing focuses on those environmental and ethical concerns. But building a so-called green retirement portfolio is one way of trying to kind of structure your investments to support sustainability and ethical practices while working towards your long-term goals. So essentially, ESG investing, the ESG stands for E is environmental factors, S is social impact, and 3 is governance practices. So environmental factors, obviously, there you're looking at sustainability, things like reducing carbon emissions, promoting renewable energy, protecting natural resources. For the social impact, you're looking at promoting workplace equity, community engagement, human rights. And then governance practices is more looking at ethical corporate practices. How many minorities are on a particular board? How many women are on a particular board? Looking at kind of transparency and reporting there and those types of leadership practices. Now, the benefits of ESG investing, it can align investments with causes that matter to you, provided that those kind of general causes do align with your values. Despite some concerns about ESG and performance, really what we're seeing is the gap closing a little bit between the ESG premium is kind of what I call it. That gap is closing somewhat. And, there's lots of speculation around why. But I think that when we get into ESG investing, companies that are kind of implementing these practices are really focused on the long game, right? I'm going to probably need an edit there because of that pop-up. Companies that are focused on ESG practices often are focused on the long-term game. And a lot of folks think that, that can deliver competitive returns by managing risks and leveraging some of those trends around sustainability, just on a broader, longer term scale. And obviously a big benefit of ESG investing is it does support broader environmental and social efforts, funding renewable energy, promoting ethical business practices, and those sorts of things, if you'd like to see more of that in the world. Now, ESG options for federal employees. You will probably not be surprised to know that the TSP's core funds do not include any kind of ESG screening at present. The TSP mutual fund window can offer access to some ESG-focused mutual funds, but there are significant limitations here. We've talked about the TSP mutual fund window before on the podcast. You'll recall you can only invest at maximum up to 25% of your TSP balance in that mutual fund window. The remaining 75% stays in the core funds. And there are significant fees. The fees can include a $55 annual administrative fee, a $95 annual maintenance fee, and a $28.75 cost per trade. So,
I really don't like that one. That's the one I like the least. But
yeah, she's not cheap. And at max, you can only leverage the mutual fund window for 25% of the portfolio, a quarter of your account there. So, this kind of makes that mutual fund window a little less appealing to a lot of federal employees. So when we look at sustainable options beyond TSP for folks who are interested in ESG investing, obviously opening an IRA, you've heard us talk about it before on the podcast, promotes a lot more flexibility to pick the mutual funds that you want. And those can include mutual funds and EFTs with strong ESG principles. If you are over 59 and a half and you are still currently working and you are somebody who's interested in ESG investing, you can look at the possibility of an in-service rollover from the TSP to an IRA to get access to that broader selection of sustainable funds. Now, you need to weigh the pros and cons of that because, there are, TSP's fees are fairly cheap, not the cheapest thing out there, like they campaigned many years ago, but they are pretty cheap compared to, an IRA that you would set up with a financial advisor and have them kind of actively managing that for you. So you need to kind of think through the rollover thing. It's not the right solution for everybody, but it can help you get access to a wider selection of investments that could allow you to tailor your strategy more along ESG lines. So if you're interested in building a so-called green retirement portfolio, I've got some kind of steps for you because, we like to focus on practical application. First thing you want to do, assess your current investments. Take a look at your portfolio. That includes your TSP. That includes IRAs you've got set up outside of the TSP. That includes brokerage accounts, things like that, to kind of take a look at what investments you currently have and if any of them are aligned with sustainability goals. The second thing you want to do is research ESG-focused funds. There's a lot out there. There's a lot of really good resources out there that you can find, but you want to kind of get a feel for what sort of options you have. And then you want to make sure when you're setting up this ESG portfolio that you are diversifying investments across sectors. You cannot focus just on one sector, just on one asset class. We still want to build a diversified portfolio that's going to weather potential market volatility. And also, we'll always mention partnering with a trusted financial advisor is a really great way to tailor the investment portfolio to your values in a way that doesn't give up your potential for appreciation. Because remember, the key here is we want to make sure, that we're putting your money to work in the market in a way that is tailored to your financial context and to your risk tolerance. So if you don't have a financial advisor who can talk with you about these things, Serving Those Who Serve would be happy to. We are apolitical. Our values don't come into play personally when it comes to managing your money. It's about you and your values.
Absolutely.
But if this is something that you're interested in, we are educated and qualified to talk with you about it.
Although, Katelyn, as you know, I do get teased for driving a Prius.
That's true.
So,
Dan does drive a Prius. We'll disclose that up front.
And it's 12 years old, so I get teased twice.
Oh, yeah.
It's like, oh, gee, you can get a new car. I love my car.
Huh?
My car has a measurable IQ.
Oh, yeah.
So,
Oh, yeah. I mean, I drive a Jeep Wrangler that I will drive until I drive it into the ground. So, I get it.
Got it.
Awesome. Well, Dan, what have you got to talk with us about when it comes to coordinating our withdrawal strategies around
required minimum
RMDs?
distributions? Here's the thing, folks. When you get to build up money in a tax-favored environment, like where you get a deduction and you don't get taxed until you take it out, Uncle does have some rules, and that means you have to take it out sooner or later. And the ultimate trigger for that is the required minimum distribution. So you get to a certain age, and then you have to start taking it out. Don't let that just happen to you. Be strategic about it. So, effectively managing this through strategy, you can do better. You can have a stronger financial future. First and foremost, when you delay taking until RMD age, Uncle gets to decide how much you have to take each year. And that amount, and we have plenty of people, clients and otherwise, who have learned to their chagrin and even sadness that it bumps them into higher income tax brackets, higher Medicare brackets. Those are nasty surprises. So you need to understand that interaction as far as planning out for the future. So RMDs, you can strategically time them. So you can take them out early. You can start before RMD age. You can also utilize charitable deductions or charitable contributions from a qualified plan to help offset that. These are things you probably want some guidance on that. But if you are a super diligent do-it-yourselfer and you are a great study on this, yes, you could probably do it yourself. Another thing that is incredibly powerful, we do it a lot, is strategic Roth conversions. So in the time between when you retire and that RMD age, whenever it may be, and I'm going to cover that in a minute because they float a little bit, you have the ability to convert portions into a Roth. It doesn't have to be all or nothing. And further, if you take a look at your current tax bracket and see how much room you have and do a conversion within that bracket, then you're not bouncing yourself up into a higher bracket. And this can be very powerful for the future because you are now moving those funds into an environment that will be tax-free forever. And for the moment, we are still under the tax brackets from the Tax Cuts and Jobs Act. Maybe extended. That seems likely these days. But this I can tell you, I've been doing this almost 40 years. Taxes go down and taxes go up. So don't assume they will always be that way for you. And if you are going to do Roth conversions, you want to do it strategically. Okay. You want to stay in the same tax bracket. Now, some updates from the tax laws. Okay. Presently, as I mentioned, the Tax Cuts and Jobs Act is set to expire December 31st, 2025. So converting before the expiration at lower rates could make sense. It could be extended. So I'm not trying to imply that you need to rush right out and do it. We also had the Secure Act and the Secure 2.0, some key changes there. If you are born between 1951 and 1959, which out of this entire podcast crew, including our producer, Olivia, it is a population of one for that. And that's me. Oh
yeah, that's why I call emoji.
That group's RMD will begin at 73. Now, if you're born later, which is the other 2/3 of this group, RMDs presently will start at 75. So that's awesome. More time for retirement savings to grow, but also all of us, we don't know where it is. There's a date out here that we're not going to be here anymore. So the later this goes, that's a smaller amount of time to get it all out. And Uncle factors that in and makes you take higher amounts. Again, that's where you can have those jumps. Now I'm going to cover something that I've been salty about, but I think I can get through neutrally today. And that is the catch-up contributions. So the regular TSP contribution limit for 2025 is 23.5. Check your TSP. Make sure that you set up to put that in over the full 26 pay periods, not too early, and you don't want to miss it altogether. If you are over 50, you can add an additional $7,500 to bring you up to $31,000. That's awesome. And if you are super duper special and you are between the ages of 60 and 63 only, you can actually do an additional catch-up contribution of $11,250, which brings your total up to $34,370. I used to grumble because I wasn't in that group, but now I realize there's a lot of people who are not in that group, so that's fine. So proper pension and RMD planning can help you minimize taxes and maximize that financial security. Roth conversions to strategic withdrawals can add additional power to your plan. So we have tons of articles on it. You can always hit us up for an individual consult. We're happy to help you. But that's what we got, Katelyn.
Absolutely. Well, thanks so much for all of that information on RMDs there, Dan. And thank you so much for working through your personal concerns around
I thought I did pretty well on that.
Catch-up.
I'm giving myself a B.
I'm very proud of you. I'm very proud of you for that.
Thank you.
Dan's been working very hard.
Yes.
All right, folks, that's all the time that we have for today. But we're going to be back next week to bring you all the latest updates that you need to make informed decisions about your career and financial well-being as a Fed.
Indeed. And Katelyn, they also need to be sure to subscribe to this podcast.
They
because
do.
Not everybody has. That's amazing to me. It's ticking up, but we want every single one of you to subscribe to this podcast on our YouTube channel or Spotify so you never miss an episode. And please, now more than ever, share it with friends and colleagues because people need good information and the message boards don't always do it. So keep that in mind.
Absolutely. For more information covered on the topics covered in today's show and more, be sure to check out our blog at blog.stwserve.com. While you're there, you can subscribe to our newsletter, The Weekly Serving, to get all the latest news for Feds delivered straight to your inbox every week. You don't have to go searching.
Absolutely. And please, please, please remember our complimentary webinars. We're running them pretty much every single week. A couple that you will not want to miss. We've got our TSP webinar on March the 20th. That's from 1 until 4. And we will have our second VERA, Voluntary Early Retirement Authority webinar. You asked, we answered. So it's up there. That'll be on 3/26 starting at 1 o'clock. We will also be dealing with discontinued service and things like that. So this will be valuable stuff. And we hope you don't need it. We hope you don't need it, but we're going to make sure it's there in case you do. And if you're looking for that individual personalized approach, hit us up at STWS@STWServe.com or meetings@STWServe.com. And you might even get to meet the OG because so many people need us. Had to open up the calendar. So it's kind of like a lottery. You can decide if you won or lost if that happens, but you can't go wrong with any of our team. They're all amazing.
For sure. Absolutely. All right, folks. Thank you so much for listening to the Fed15. I'm Katelyn Murray.
And I'm Dan Sipe.
And we will see you guys next week. Take care.
Absolutely. We'll be here.